US and global growth stocks specifically have been the standout performers over the past few years, with the S&P 500 actually compounding at over 10% over 5 years. Now, if you look at other parts of the world, we've seen markets like the UK, emerging markets like South Africa, and value stocks generally underperforming. And in fact, investors in the FTSE 100 and the JSE All Share have made zero returns. Now, if we look at markets today, despite the US and many global growth stocks making record highs, there are parts of the market that have been left behind. And we actually calculate that about 2/3 of global stocks are currently trading in a bear market. If you look at the history of the US market over the last 120 years, starting valuations have been the key determinant of long-term returns. When valuations are low, subsequent long-term returns tend to be high, and when valuations are high, the opposite is true. Now, in that context, if you look at the current valuation of the S&P 500, its cyclically adjusted P/E ratio, also known as the CAPE ratio of 30 times, has only been higher twice before, which was during the dot-com bubble of the late 90s and also just before Black Tuesday in 1929. Now, while starting valuations are not really a strong determinant of shorter-term returns, they matter a whole lot over the long term, and we think investors wanting to generate good long-term returns need to be buying equities where valuations are low. Investors tend to be drawn to what has worked in the most recent past while avoiding what hasn't. While that's been a great strategy in the last couple of years, we think investors are being too complacent in a number of areas and are too focused on the qualitative narrative while ignoring valuations. We are seeing these conditions today in many well-loved global growth stocks, in US equities, and in US tech stocks. We have the strong view that sky-high valuations and expectations are not a recipe for strong long-term returns. Now, in contrast, there are parts of markets where fear has become the norm, and investors have shied away from these markets. While low share prices in isolations do not determine value, we have the view that investing into areas that have become uncrowded and unpopular tends to provide one with the best investment opportunities. We are seeing these conditions today in the Japanese market and Japanese financial stocks specifically, in emerging markets like South Africa, which we're actually seeing to be one of the best global opportunities, in select UK retail and agricultural stocks. We think Japan is one of the least crowded markets globally. What is striking about Japan is that not only are valuations back to financial crisis type levels, but also the starting point in terms of corporate governance and balance sheets. While the consensual bear case is that Japanese companies are value traps and that management teams ignore shareholders, the reality is that we are seeing a significant improvement in governance and focus on shareholder returns. With that in mind, we're seeing significant increases in dividends being paid by Japanese companies and also increasingly the use of share buybacks. In fact, for 2019, we expect Japanese companies to return about 22 trillion yen back to shareholders, which is about 3.7% of market capitalization. And then furthermore, another major difference to the US market, which attracts us to Japan, are starting balance sheets, where the Japanese corporate sector has strong balance sheets compared to the US, which is highly geared. One of the several Japanese financial companies we own on the portfolio is a company called Japan Post Insurance, also known as Kampo. The company sells low sum assured, simple insurance products through Japan's 20,000 post offices. It's got a track record of growing its embedded value by 6% over the last 6 years, and it generates a return on embedded value of 8.6%. Now, what we've seen actually in the last year is that Kampo returned about 10% of its market cap back to shareholders, both through dividends and a large buyback. And while the company is currently undergoing some issues with its sales partner, it is trading at a valuation of 0.3 times a price to embedded value and a dividend yield of 4%, which we expect to grow strongly in coming years. What is interesting to note in the Japanese market is that we expect Japan's insurance gap to widen over the next 10 years, and that's despite Japan's aging demographic, which will likely result in growth of the life insurance market, which is to the benefit of Campo.